This is Tchaikovsky, and we're going to go over today some additional cash flow questions. This video is copyrighted by myself, Bennett Tchaikovsky. Any contents contained herein are my own opinions and my own alone. And here we go. Okay, so the first thing if you're taking my class, there's a companion problem to chapter 20, which is essentially I give you a cash flow and then have you prepare financial statements. However, for this one, I'm giving you information and asking you to build a cash flow. So if you can't remember something, or if something's happening, or if you start freaking out or something along those lines, you can go through and essentially look at the other cash flow question, and hopefully get some clues in terms of how to go through and to answer it. So we're given a situation where there is a bank loan. You're seeking a 4-month, $2 million bank loan on August 1st, 2030. You are a loan analyst and have been asked to create a 4-month cash flow to evaluate whether or not LGA should receive the loan. The loan will require that 0.75 interest will need to be paid each month, and the full loan amount will be due on 11/30/30. So the thing you want to do when you get these questions is you want to kind of start going through and kind of like building out the cash flow. So you're going to have basically your beginning cash balance. We're going to add in our inflows. That's going to give us our total cash available. And then we're going to have our cash outflows. And then basically our ending, so we're going to have total cash outflows. And then this will give us our ending cash balance. And one of the things I like to do when I'm doing, so this is August 30, this is going to be 9/30, August 2030. It's going to be 9/20/30. This is going to be basically be October. And this will be 11. Okay. What I like to do when I go through and do these questions is the first thing I want to kind of go through and put in are essentially, I'm asked to see if this company can go through and pay back a loan. So what I want to do is I want to basically show the loan proceeds. And then I also want to show at the same time the loan repayment. And when I look at this, they're seeking a 4-month, $2 million bank loan. So this money would be coming in August, right over here. And then the loan would need to be repaid in the month of November. So go ahead and put in that loan coming in and then the loan going out. The other thing you also want to go through and do on this particular question is also 0.75% of interest is going to need to be paid each month. So what we also want to include as well is the interest payment. And the way we're going to figure out that, and I want to make sure that all of you are kind of following along this at home, I intentionally do this to mess around. Basically, if I have a point of 0.75%, what does that mean? It means it's 0.0075. If I'm converting that to a decimal, because this is less than 1%. So what we're going to go ahead and do is basically say, well, 2 million times 0.0075 is 15,000 per month. And, this kind of looks, does that look right? Well, 1% is, 20,000. This is, 3/4 of that amount. So again, for the interest payment, this is going to be 15,000 every single month, right? So if I borrow this 2 million, I'm going to have to pay 0.75. Again, I've graded enough of these exams to see what gives students the most amount of trouble. And when I give them a 0.75, It's not 75%, it's a fraction of a percentage. Okay, so they had the following balances. We put in the loan and we had the following balances. So we had the ending balance as of July 31st is going to become the beginning balance of cash for the following month. So my beginning balance on August 1st is in fact going to be 1.8 million. So now what I have to go through and do is it basically gives me some information about the accounts receivable and accounts payable. This brings up a very important point. When I'm going through and doing anything that is budgeted, that is not the same thing as cash being collected. So what I need to go through and do is I need to basically convert these budgeted sales, right, that are right over here. And I also need to take the information about the accounts receivable, which is the beginning balance as of July 31st, and to kind of go through and see how this is going to be going through and being collected. So these are budgeted sales. It is not the same thing as cash from sales. So what I want to go through and do is to basically create a cash flow for these amounts. Now, it also gives me some additional information. It says of the budgeted sales, 40% is collected in the month of sale, 25% in the following month, 30% in the second month, while 5% will be written off as uncollectible. So what we're going to do over here is we're going to basically have all these different months. And so what we're going to try to go through and do on this is we're going to kind of say, okay, our August budget, or basically, let's start with the prior balance first. My prior balance of accounts receivable was 600,000. How are we going to be collecting this? Well, it tells us that we're going to get 550,000 on August, and the rest is going to be collected in September. So in the month of August, I'm going to have 550, and then in September, I'm going to have 50,000. Most important thing, you want to kind of go through and let's go through and check our work. If I add up these two amounts, I'm going to get up to 600,000. Remember, we have to convert this. We need to know our cash received from sales. This is not the same thing as budgeted sales. Very important. So we're basically taking our budgeted sales and converting it into cash from sales. So over here, my August. So over here, the AR or sales, August, September, October, November. So over here, my August sales budgeted were 2 million. My September sales budgeted were 2.2. My October sales budgeted were 2.4, and my November sales were 1.9 million. Okay, so how do I go through and collect these? Well, in August, it says I'm going to collect 40% in the month of sale, 25% in the first month following sale, 30% in the month after that, while 5% will be uncollectible. So if I'm getting 0.4, 0.25, 0.3, I'm collecting 95% of the balance, 5% will not be collectible, and that's how we get to 100%. So over here for August, right? So I'm collecting 40% of the balance in the month of the sale. I am then collecting 25% or 25% times 2 million or 500,000 in the second, basically in the first month following sale, and then 30% in the second month following the sale. Now, if I want to go through and check my work, when I add up these three amounts, I get 1.9 million. Well, does that number look right? Well, if I take 2 million, multiply it by 95%, I get 1.9 million. So I know I'm on the right track because it doesn't equal to 2 million because remember, I'm writing off 5% or $1 million. Now for September, Huge mistake students will make is they say, well, I got 40. No, we didn't, because it is going to be not applicable for the month of August, right? Because September sales don't happen in August, they happen in September. So what I want to go through and do is that for October, I'm not going to start collecting the 2.4 million in August or September because I would need a hot tub time machine, and I clearly don't have that. But over here, also for November, I want to write in not applicable, because when I write in NA, the sales have not yet happened for these months. So these are going, I can't collect September sales in August. I can't collect November sales in August. So I want to go ahead and block these out. Let's go ahead and do September. So I'm collecting 40% in the month of sale, 25% in the month following sale, and then over here, 30 month, and then that second, basically that second month following sale. So over here, I've collected 4,290,000. Whoa, actually, I didn't do that right. Hold on. I am collecting 2,090,000. Is that number right? Well, if I take 2.2 million and multiply it by 0.95, I know that that number is correct. So let's come over here and let's go ahead and do October. Remember, I don't collect October in August or September. So I'm collecting 40% in October. I'm then collecting 25% in November. I am then going through and collecting 30% in December. Now, you might be saying to me, Bennett, well, do I have to go through and look at those future months? The reason why I would do it is because we want to go through and check our work. If I can go through, take 2.4 million times 0.95, I know that this number is correct. So now for November, I'm collecting 40%, 25%, and then lastly, I'm collecting 30%. And if I add these up, I get 1 million to, wow, my math is off today. So I get 1,805,000. That's how much I'm collecting. If I take 1.9 million times 95%, I get 1,805,000. So once I've gone through and I have done this, so the amount that I'm collecting in the month of August is going to be 1,350,000. The month of September is going to be 1,430,000. The month of October is going to be 2,110,000. And in the month of November, it's going to be 2,020,000. Right? And I don't have to worry about these months, but I was just putting them in there just to make sure that the numbers were right. So in my cash received from sales, right down over here, right, this amount, I'm going to basically be putting this in from my cash flow, or basically my breakout of this below. So over here, cash flow is 1,350,000. 1,430,000, 2,110,000, and then 2,020,000. So that is my cash received from sales. Okay. So let's go ahead and see what other information we have to kind of go through and deal with. So we've dealt with the beginning cash balance. We've also dealt with the loan amount and that interest amount. We've also dealt with the cash as well, the accounts receivable, as well as the budgeted amounts of sales. Now let's take a look at our budgeted cost of sales. And let's bring this down over here again. And I also have an accounts payable balance from previously right over here. And I also have, so I got my accounts payable balance. And then over here, so there we go. Okay. Okay. So now kind of going through and looking at this over here. Let's see here. Oh, I know what happened. Okay, so this is going to be, it's going to be August, August, September, October, November. Okay, so this is the budgeted cost of sales is not the same as the amount paid for cost of goods sold, right? So it's a budget. It's not the same as the cash paid. We're trying to figure out what is the cash paid. And what it tells us is of this, basically the accounts payable, of the AP balance. We're given a little bit more information. as of 7/31/30, 400,000 will be paid in August, while the remaining will be paid in September. So what I want to do is I'm going to go ahead and set up a similar chart. And when I'm setting up this similar chart, it's going to be AP or budgeted COGS. And then I'm going to have my prior balance, which was 425,000. And then I'm going to have over here basically my amounts for August, September, October, and November. Okay. Okay. So this over here is going to be 1.1 million. This is going to be 1.2 million. This is going to be 1.375. And this is going to be 980,000. Okay, so coming right over here, it tells me that of the AP balance as of 7/31/30, 400,000 will be paid in August, while the remaining will be paid in September. So that must mean it must have been 25,000. So that he has to equal up to the whole thing. For August, right, I am paying 55% of the month for the cost of sale, and then the remaining amount, which would then be 45%. So this is going to be 55% times 45% over here. Always want to check my work. These things equal. Okay, now similar to what we did up here, do we pay for any cost of goods? Do we pay for a September cost of goods sold in August? And the answer is no. And the same is going to be for October and November. So similarly over here, we want to put a big not applicable, right over there. So again, be 55% in September and then 45% over here. Want to make sure that my numbers are adding up. And then over here, I've got 55% in October and then 45% in November. I want to make sure that these numbers are adding up. 55% in November and then 45% in December. Or a total over here of 980,000. Okay, so my total cash paid for cost of goods sold is going to be 400,000 plus 605, 25,000 plus 495 plus 660, 540 plus 756, 618, 750 plus 539. Okay, so that's my cash paid for cost of goods sold. So what we're now going to be able to do, because we've converted these budgeted items into the cash paid, come up with a new color. I can now put this into the cash flow. So cash paid for cost of goods sold. I'm going to go ahead and start down over here with this number here of $1.5 million. And I'll go ahead and do the nice little coloring here. There we go. Okay. So that's those are basically the first two parts. And as I'm going through and looking at this, I probably want to give myself a little bit more room. So let's go ahead and do that. Okay. So dealt with now basically the accounts payable, the AP balance, and then the budgeted cost of goods sold. Okay, now the next thing I look at over here is that I have sales commissions, which is usually going to be based on budgeted sales, office expense, sales and office staff costs, and then I have depreciation expense. You will almost always see me put in depreciation expense. Why? It's because when I record depreciation expense, I'm debiting depreciation expense and I'm crediting accumulated depreciation on the equipment. So this is a non-cash item. So I just want to disregard it, right? That's what I want to do. I'm just going to disregard that amount because it is a non-cash item. So, and also too, if you look over here, is there any depreciation expense that comes out of the cash flow? The answer is absolutely not. So again, we have to add in depreciation to go through and do income statements. It's part of the income statement, but it's certainly not part of the cash budgets. Okay. So over here, what I'm now going to kind of go through and write is I'm going to have sales commissions. I'm also going to have office expense, and I'm also going to have sales and office staff costs. Now, when I'm looking at this, right, I want to kind of remember that these amounts are monthly, right? So this 215 of office expense and this 437 over here of the, sales and staff office costs, these are going to be happening every single month. So these are not going to go through and change, right? When it comes to the sales commissions, we're going to basically take it as 8% of sales. Typically, the way salespeople get paid is just going to based on their actual sales, not when it's collected. So we're going to take 8% times 2 million. We're going to take 2.2 million times 8%. We're going to take 2.4 million times 8%, and then we're going to take 1.9 million times 8%. So at this point, we have gone through and we have dealt with all of the different items that we need. Now, what is the time to go through and to do is to basically say, okay, what is our cash available? Well, it's going to be my beginning cash balance plus the loan plus the cash received from sale or 5150 or a psychiatric hold. My total cash outflows are going to be the loan repayment, which is 0 right now, the interest payment, cash paid for cost of goods sold, sales commissions, office expense, and then sales and staff costs. My ending cash balance will be my cash available minus my total cash outflows. This ending balance here is going to become my beginning balance for the following month. So this becomes my beginning balance for the following month. And then I'm going to go through the same process. I'm going to come right over here. What is my cash available? It's my beginning cash balance plus my cash received from sales. What are my cash outflows? It's going to be 15,000 plus 1,180, 1,180,000, 176, 215, and then 437. So my ending cash balance is going to be 4,748,000 minus 2,023,000. It's going to be 2,725,000. My ending cash balance becomes my beginning cash balance for the next period. Over here, my cash available is 4,835,000. And then over here, my outflows are 2,155,250. My ending cash balance is going to be 2,679,750. This ending cash balance here becomes my beginning for the month of November. And now we get into the fun stuff. My cash available is going to be 4,699,750. But my total cash outflows are going to be significantly different because I am repaying the loan. So if I come over here, I have 3,976,750. So my ending cash balance is going to be $723,000, right? So that is going to be the cash flow for this particular question, right? Key things that you want to do on this, just by a recap. Want to show the loan. So first off, if you're taking my exam and you forget how to set it up, go to the cash flow where I'm asking you to go through and convert it into financial statements. But what you're going to go through and do is you're going to essentially go through over here and you're basically going to put in the loan coming in. You're going to show the loan coming out. You're going to show that interest payment going out every single month. But then what you're going to have to do is you're going to have to convert budgeted amounts to cash amounts. And you're going to have to use the information to go through and figure that out. Don't forget to write out the not applicable. I've seen students make this mistake a lot, just write in not applicable, because I can't collect September sales in the month of August. Okay, so now that I've done that, the final part of the question is that based on your estimate, would you recommend for your bank to loan the money to LGA? So there's a couple of different approaches you can do to this. However, what I would do is make sure that you quantify the reason why or why not you should be giving the loan. And so let's go through and kind of look at this. LGA started with a $1.8 million basic 1.8 million cash balance. After 4 months of operations, if the loan is repaid, the ending cash balance for LGA is $723,000, or a decrease from the initial balance of $1,077,000. Okay. Also, you can say that the budgeted sales seem to be declining from October to November from 2.4 million to 1.9 million. Or a decrease of 500,000, or %21. How did I get 21%? I took the decrease amount, divided it by 2.4 million. If I multiply 2.4 million by 21%, I get roughly 500,000. It's obviously I'm rounding. So therefore, we should not extend LGA alone. That's what you could go through and write, and I would accept it. Now, notice over here, the most important thing you can do when you're giving any type of explanation is to quantify your answer. If I go to LGA and say, dude, you're LaGuardia, you're the worst airport in the world, you're terrible, we're not going to give you anything. Yeah, that's an answer, but it's not a really it's not a quantifiable answer. You want to use numbers to go through and to tell your story. This is all about using numbers. It's not to deflect responsibility, but it's using numbers to go through and to explain as to why you're going through and, taking a particular approach. In any event, hopefully you found this video helpful. Thank you for liking and subscribing, and I will see you on the next video. Have a great day.